Hi, this is Bruce Blythe with Farm Futures. I'm at Ag Market Net's annual Farming for Profit Time for Price conference in Nashville, and I'm here with Brian Split. He's the chief strategist for the company and also their head technician. So we're going to be talking charts a little bit today. Brian gave a really good presentation on charting systems, and we're going to talk about a couple of key markets important to farmers. But first, Brian, just for some, maybe you could just briefly explain why it's important, even if you don't trade futures, why is it important to follow the futures markets? I know the chart.
Yeah, sure, Bruce. I think the chart is really just a visual representation of the price behavior of each individual market. And within those price patterns, there are historical evidence of certain patterns providing certain outcomes. And so I think at the very least we can identify what the trend of a market is. Is it up? Is it down? Is it sideways? And then if we can identify a little further, maybe some patterns within those trends to help us get an idea of where prices may be in the future.
And help inform hedging marketing decisions.
Correct. Yeah, I do a lot of my option structures are based on how I view the chart.
Okay. So we're going to take a closer look at a couple of key charts. This is the December 2026 corn chart. And Brian, can you point out a few key trends or points that you're watching and producers can keep an eye on here as we get closer to the growing season?
Absolutely. I think the chart tells a story. If we kind of think about what was happening prior to 2023, we had the bull market that started in 2020 that culminated with the highs that were scored in 2022 after the Russian invasion of Ukraine. And from 2023 on into 2024, we had a bear market develop. So we've got a little bit of a downward trending channel on the DS26 chart. That trend exhausted itself into August of 2024, which was ultimately the bottom of the market on the crop from last year. And then from that point forward, and this has been about a year and a half, we've had really just sideways price action. And this market has been trading primarily in about a 30-cent trading range, where 440 is the low end of the range and 470 is the upper end. And we've had maybe a handful of pops through 470 up to 72 and a half or 75 and a half or 77. But all of those events were very short-lived. And we inevitably found ourselves back into that trading range very shortly after. So the story that this chart is telling me is that the market is very happy in this trading range with the information that it knows currently. We'll be getting some additional information as far as what the acres for next year's crop will look like at the end of March. We're going to get a new balance sheet for new crop from the USDA in May. And then we're going to see how the planting scenario looks. But I think you have to have a structure in place where you have a worst case scenario established. A move below 440 in the big picture is not going to be a good development. If we can get through the 470 upper end, then maybe we can see some better pricing opportunity. But a lot of my new crop hedging structures will be based on the trading range that we're in currently. I want to have unlimited downside into next fall in case we do have good weather and a large crop again. But I also want to have the ability to take advantage of upside potential if this market breaks through what I would call continuous resistance near $5.
Well, that's really good stuff, Brian. Very informative and helpful, and I think tells you a lot about what's been happening in these markets and also what could happen here in the months ahead. So Brian, thank you for the time today. I really enjoyed your presentation, and thank you, Ag Market Net. This is Bruce Blythe. I'm with Farm Futures.